Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Because what could be more important than real money? You know, it's much, much more fun to play with real money than play money. Fake money, it's no good at all. Well, okay, some fake money is called cryptocurrency, but we're of the opinion that that's probably no good at all either. Let's talk about real money, given the name of the show. And to help you talk about real money, you have your two hosts here at the program/podcast. Don McDonald, that's me. And over there, underneath, what aircraft is that right above your head?
I'm not looking up. It might fall anytime.
I don't know. Yeah, I can't tell.
Actually, that's a Russian plane. I probably have to take that down.
I would take that one down right now.
Yeah, given
the circumstances,
42, it's got to go.
Given the circumstances, I think the Russian plane needs to go. Yeah. Okay.
Right, sorry.
So that's Tom Cock, by the way. Yeah. And we're here. We're here every Saturday on Northwest News Radio, and then almost every day of the week on our podcast, guiding you through the confusing maze of money matters that make you a little mad. I just love alliteration. So give us a call. If you've got a question, give us a call. 855-935-TALK, 855-935-8255. Now I have a question for all of you. All of you investors out there, your stock portfolio is going blank. Which way is your portfolio going?
That's a trick question.
It's a trick question. Which way is your portfolio going? Which way has your portfolio gone? I bet many of you will say down, Tom.
Yeah, and many of you would not have been paying attention to last week. By the way, the best performing security, if you can call it that, last week was, any idea?
Nickel.
Nickel was among them, but not the best. The Russian ruble up 25% last week.
Well, okay, when it goes, 25% of nothing, though, is not much.
Well, that's true. Yeah, the reason we bring this up is because there's a new survey out by Mass Mutual that finds that 2/3 of us, we're worrying about the conflict in Ukraine and what that will mean to our checkbook. I think that makes sense, right? I think that there's nothing wrong with worrying about that. That's reasonable. But here's the unreasonable part. 42% of the people surveyed, they're delaying investing because of this. So one of them said, this is one of my favorite all-time quotes, Don, I'll wait until things settle down. I'll wait until things. Well, let me just.
What are the numbers? What are those numbers on what people? I mean, this is a real survey. It's by a real company, even though they're an insurance company.
Yeah, we're going to give them credit for this. So last week, while you were waiting for things to calm down, the Standard & Poor's ended up 6%. If you're more into technology, NASDAQ up 8%. And here's the other part. Because everybody I meet with thinks, I've gotten creamed this year. It's been a horrible year. The stocks are way down, blah, blah, blah. Bonds haven't made any money. Well, okay. We'll give you both, I guess. The 100% stock portfolio down 2.5% year to date. Is that really? That's no Harry Dent creaming, certainly. And the 60% in bonds, 40% in stocks, down still 2.5%. There's places where you've made money, U.S. small value, et cetera, et cetera. It has been way overblown in the media. No surprise there. And what it does is it leads you to all kinds of apprehension, worry, and about what should I do with my money now? And you know the answer. Nothing.
Yeah.
Invest properly and leave it.
And you know what's funny about this? It was only 2 years ago, just 2 years ago, that we had a far bigger decline by this this exact date than we've had so far this year. And everybody was scared to death then.
Because we'd never had that before.
We never had COVID. That's new.
Oh, yeah, well, now we've got 100 years before. Yeah.
Now we've got World War III, everybody thinks. And so what am I going to do with my money because of the war? I'm going to wait until things calm down. Wait till things calm down.
I like settle down. So here's a couple things to keep in mind if you're one of those. Best days in the market follow many of the worst days. We've seen that regularly, right? In other words, big downs follow, so you don't want to miss the big ups. Number 2, your long-term strategy ignores the current market conditions. And number 3, as we always tell you, you need to know your risk tolerance, how much volatility you can accept emotionally. And then the rest of this, well, it's noise.
You just leave it alone.
Yeah.
Really, you could put us out of business. If you would do this right, you could put us out of business. So those of you who hate us, if you just start investing properly, we won't talk anymore. But if you want to talk with us, it's easy to do. All you need to do is go grab one of those telephonic devices like this iPhone I have here and call us at 855-935-TALK, 855-935-8255. What are you doing right now with your money? I bet you a whole bunch of you are waiting. I'm waiting. I'm just going to wait and watch. What are you watching for? What exactly is the signal that you're expecting? Because let me tell you, if it looks like the war in Ukraine is going to end tomorrow, stock prices are going to soar right about at that moment, not after you react.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Are you tired of low U.S. bond rates? Are you sick to death of only making 1 or 2%? Well, ladies and gentlemen, I would like to share with you today a wondrous offer from a government that will back your bonds 100%. 100% guaranteed without limits. That bank.
This is true.
Here's
this
Uncle,
is true.
Let Uncle Tom at our bank tell you more about these wonderful bonds.
Thank you, my friend Don. Thank you so much, because this is guaranteed money. Okay, now it
now
is
tell
guaranteed
them the
by,
interest rate.
Yeah,
please.
The interest rate. Here's the paltry 2% 10-year bond that now the U.S. government's issuing. That is nothing. No reason to own that when you can own the 11% Ukrainian war bond. This is serious. I mean, 11%.
And you remember how well those Confederate war bonds did.
Paying off. Yeah, now it is guaranteed by the full faith and credit of the Ukrainian government, which I guess is still hanging in there. I mean, I don't know. Day to day, it's a little worrisome. No, this is not something I would buy. I know people are
11% guaranteed by the Ukrainian government.
And by the way, if I was going to buy a Ukrainian war bond, I'm going to want more like 20%.
I'd want more
That's
than
just
that.
me. Maybe or 30 or something like that. So, but at any rate, because we all joking aside, the horrible war continues, and we talked at the top of the show about the fact that has pushed stock prices down a little, not very much,
and
that has caused you a lot of worry. But then the other part of the equation, of course, is interest rates, and the Federal Reserve this week, Don, they raised the Fed funds rate by 0.25%.
Well, then, Uncle Tommy, I need you to get me out of those lousy U.S. bonds because interest rates are going up. Now, see, if interest rates are going up, why should I be in bonds?
By the way, I will send this paper to anyone who doesn't believe us. Seriously.
Which paper?
If you write me, this paper from Dimensional Funds, they wrote a paper looking at
you didn't
government.
even. Okay, you said I'm going to send this paper, but you should describe the paper before you offer it.
The paper is a look at bonds, government bonds, 1984 through 2021. There is according to this paper, no reliable relation between changes in the federal funds rate and future bond excess return over cash or future term premium. In other words,
explain that, because that sounds that sounds like industry jargon.
That does sound like in other words, there's no reason to sell your government bonds and move the money to cash. The premium, the additional return you get for the risk of government bonds compared to being in cash continues, or at least it has in the past. And so there's no relationship, again, to them raising rates and bonds necessarily paying less in the future.
And I have had this argument with several people, some I'm very close to.
Yes,
that
see you're standing over your shoulder.
If interest rates are going to go up, and the Fed has said they are going to raise rates, then why shouldn't we wait to buy the bonds until they're cheaper? And my response is always this. It's kind of like the same thing with the stocks, where people are saying, I'm going to wait until they get cheaper. The war in Ukraine is built into stocks right now. The increases in the next year or so in the Fed funds rate, which is an overnight rate, are already baked in to the price of bonds today. It would take a surprise, an extraordinarily bigger rate increase, for the bond market to be surprised and panic and some of the owners to sell their bonds.
Yeah, and I took a look, by the way. The intermediate term bond year to date is down over 4%. So it has lost money so far this year. The shorter term corporate bonds are down a little over 2%. So both those bond funds have lost money. But let's be honest in terms of perspective. When stocks go down, they lose 20, 25, 30%.
That's the point.
And people forget that. They think, well, but bonds are going to lose money. They're losing. Well, yeah, they're losing a little bit, but not a lot. And again, this paper shows you. And yes, if you send me a note, I will be glad to send you this paper. It's available to anybody.
The reality is that for U.S. bonds to decline by the 20 or 30 or 40% that stocks can would require the U.S. economy to be almost as bad as that of Russia. For our dollar to be that devalued, that shorter, longer term rates have to be that high. They have to go quite high to get to a 30 or 40% loss in bonds. And for that to happen would require the dollar to be worth almost nothing. And nobody is expecting that. Nobody except the big bears.
Yeah, and again, and we could get into all those if we want.
Harry Dent.
You'd have to see them coming by to pick up Jeff Bezos's yacht at that point, and that's not happening either.
Yeah. So what we're trying to say, and I hope we're saying it reasonably well, is that you cannot play these long-term games. This is the mantra we keep repeating over and over again, because no matter how many times we say it, we hear from you all the time, telling us that you have a better idea than just buying a diversified portfolio and holding it long term and only adjusting it as the portfolio's balance changes.
And here's an interesting point, Don, because people are talking about rising interest rates and it's going to be tough, et cetera, et cetera. The Fed funds rate, do you know this? In 1981, it was 19.
Wow.
By
1989,
19%. By 1989, it went down to 9.8. In 2000, it was 6.5. 2007, 5.2. And then, basically today it's right at zero, basically. I mean, it's really nothing. So money is still extremely cheap.
And
today.
What's curious is that in those days, when we had those high Fed funds rates, those short overnight rates, the yield curve was inverted completely. When I was a stockbroker back in the early mid 80s, I was selling long-term government mortgage-backed securities at 12% when the short-term rates were substantially higher. So things are always changing and fluctuating, but not in ways you would necessarily expect, and certainly cannot predict. You cannot predict them, no matter what your gut tells you.
And I think I saw you in Margin Call unloading some of those mortgage-backed securities, didn't I? You look good.
I got to tell you.
You're the guy with the eyebrows in there.
I was.
Eyebrows and
when that happened, when both of the mortgage-backed securities debacles happened, I was no longer in the brokerage business.
Thank goodness.
And I was on the radio, and I was telling people to steer clear of these things because they could not. I didn't know what was wrong with them because I'm not that smart. I don't get into the numbers like those analysts do. But I could tell you that anything that tries to do this, that tries to pay you more than the going rate with a similar or even sometimes they said lower level of risk, just can't exist. It's impossible. 855-935-TALK is our phone number. You want to talk about your portfolio? Give us a call.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And you don't want to miss next week's show. Next week's show is going to be an experience unlike any we've experienced in the last several years. Ladies and gentlemen, Don McDonald and Tom Cock, both in the same room at the same time, live on your radio and then taped and played later on our podcast, because Tom is coming to Orlando, Florida for... What's your cue?
I can't. Oh, a soccer game. That's what I was trying to remember why I was going there. Yeah, the U.S. men's national team. And I'm going to make a bold prediction that they will, at that game, with your... honored by your presence, Don, because this is the first ever U.S. men's national team game you've been to.
Oh, yes, it will be the very first, yes.
Maybe the last. They will qualify there for the World Cup finals in Qatar next, I don't know, is it Dubai? I always forget the capital. Anyway.
Qatar is its own Qatar.
It's a country.
Qatar.
Anyway,
it's actually pronounced Qatar.
It's like welcome back, Qatar. That one.
Yeah,
anyway,
Qatar, yeah.
So they.
He's such an American.
That's why we're going there. But we're gonna be going.
And it's going to be
I'm so.
Tom is going to be so depressed if this doesn't work out the way he expects.
It's going to work out. What?
Right.
Come on, a little optimism here. Come on.
I don't know soccer. I know that they kick a ball around. 855. I actually played soccer in high school. I was horrible.
That's a scary thing.
I was horrible. Can't remember.
I didn't know that.
Can't remember a single rule. I was the only kid on the team who didn't get a jersey. They ran out.
By the way, the good news for you is there are no rules in soccer. There are laws.
Oh, I thought you were going to say there are no rules in soccer. Just suggestions.
Everything.
Just
by the way,
suggestions.
yeah, for those of you who want to argue with my calls tomorrow, remember every call is at the referee's discretion too. So when people say you got it wrong, I'm like, nah, it's a referee's discretion.
So
sorry,
it's however Tom feels.
Exactly.
Yeah. All right, 855-935-TALK is our phone number. Rob, you're up. Welcome to Talking Real Money.
Hi, Tom and Don. Thanks for taking my call.
Hey, Rob.
About half of our nest egg that you'd say is divided stocks and bonds, 50-50. And in the bond category, I have a couple of funds like Dodge and Cox Income is one of them. Pioneer Strategic Income is another, and Prudential Core Plus Bond Funds. And I've heard you talk about dividends, how some of these funds that pay high dividends, they basically are just bleeding down the value of the stock with their dividends. And just like to get your opinion.
Well, wait, can you give me those again? Because
mixing your metaphors there, because I think you were talking about a bond fund at one moment, and then you said paying out high dividends. Obviously, a bond fund is going to be.
Give me the names of those funds
interest.
again, because I was trying
Dodge and Cox. I had the first one.
Oh,
Dodge and Cox.
Dodge and Cox. What?
Yeah,
Income.
Dodge
Income.
And Cox Income.
Okay.
Yep.
You have a Pioneer fund?
Pioneer Strategic Income.
Before even getting into how they manage the money, I can guarantee you one thing about those. They are high expense, actively managed funds, which is not something we'd recommend because you're giving away a lot of the return, especially with
You got the
income.
Pioneer through a stockbroker or something, right?
Oh, for sure.
Well, no, these are in my 401k.
Oh, okay. So it would probably then be the Strategic Income, our shares more than likely.
And by the way, if they have a bond fund or any funds there that are indexed, we'd recommend those over the Pioneer. Don?
Oh, my goodness. My jaw just dropped when I saw the expense ratio. This is of an institutional fund, Tom. What do you think an institutional income fund costs?
I'll go crazy here and say 75 basis points.
Try 1.37.
Oh, that's outrageous.
Yeah. That's a really expensive fund, sir. That's ridiculous. Dodge and Cox, I would not be in that fund on a bet. Dodge and Cox.
So do they have an index fund alternative? They should, like the Vanguard Total Bond or some other, index product that
Fidelity,
you could use instead?
whomever.
Well, inside,
do they have another choice?
Inside I could be in the Vanguard. I could be in the Vanguard Total Bond Market Index.
Buy Pioneer,
Yeah,
buy Dodge and Cox.
Yeah, I'd kick those to the curb.
All right.
Kick them both to the curb. They both have what appear to be higher yields, but they do the higher yield with additional risk, and a lot of additional risk in the case of Pioneer, because they have to take out of your income enough to pay them 1.3% per year.
Which is probably all the...
That's all that bonds make.
Yeah, I was going to say, that's the yield the whole thing pays, so they got to figure out another way to generate that. No, that's... Honestly, on a spectrum of 1 to 10, that's a 10 in terms of expense ratio.
That really is. That's off the charts. And Dodge and Cox not as bad at 0.42%, but again, that's still too high, and that sucks down about a sixth of your real yield on safe bonds. Thanks for the call.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
You know, everybody at some point or another needs help with money. Everybody, including us. If you have any, we'd love to share it with you. 855-935-TALK is our phone number. Well, we don't mean, okay, we share the money with you too, but we share help with you. A little help here and there. You okay over there?
Help? Yeah, I'm good. I'm good.
All right, just checking.
Just when you said a little help. You know what, you mentioned
he's just across the room. He's just 3,000 miles across the room.
Well, first you did mention that we're going to be in the same room. That'd be the first time in 2 years that I've seen you like in person, because you could have been a computer all this time and I never would have known.
Yeah, last time was Retire Meet COVID edition.
Yeah.
the Retire Meet super spreader event.
Thank you very much, Vestory.
We didn't know.
Yeah, we didn't know. So, so it'll be kind of fun going to Florida and sunshine, kind of warm. That'll be nice, too.
Yeah, it's going to be, perfect. Actually, you're going to get perfect weather. You're going to get upper 70s, no rain.
Looking forward to that.
Telling you.
I got to go dig in my closet, see if I can find something to wear.
Oh, you always have those you have those old Alaska cruise shorts that I love so much.
Taku
with the
Glacier Lodge.
With the white piping. Yeah, I love those.
That's about all I got. So
855-935-TALK. Give us a call. Or you can also send questions in. We just get a lot of them, so we better get to some of them that are sent in at TalkingRealMoney.com, like this one. Here you go, Tom. Get your pen out. Take your notes. I will retire in 14 years at age 55 with a police officer's pension. Ooh. That will replace about 85% of my income. My wife and I have about $400,000 in Vanguard target date and total stock market. About $50K is a Roth. Given the pension requires me to pay 15% of my paycheck, I'd really like to cut back on the 401K, currently saving 12%. Yeah, because you're saving 27% then. That's a big chunk of income. And I have some extra money now. We live only on my paycheck and things seem tight. When I first started, an insurance agent told me I shouldn't plan on the pension for retirement, so I've tried to save as much as I could. Of course, he tried to sell me whole life policies after telling me not to rely on a pension. Do you think I could safely let off the gas a bit? We currently spend about $50,000 to $60,000 a year.
Well, first of all, I want to say thank you for being a police officer, because, man, what a
thankless job.
Unfun job. It always is.
And he's
really
one in Minnesota.
Years. Wow. So, yes, the short answer is yes. First, let's go back to your pension. I mean, I think it's slightly irresponsible to tell you that you won't get your pension. I think anyone who has a pension, like a public, you're going to get it. It may be a little different than what you think in 15 years, but wow, I think that's kind of irresponsible, especially as a way to sell
it's to sell something. Policy. It's to sell an annuity or whole life, as you said.
You know, I mean, the other part is, let's go out and have a little more fun here, because I tell this to people all the time. It sounds kind of morbid, but we never know how long we have. And you should spend some of the money today to enjoy yourself.
And here's a great way to look at it. That money that you're saving in your 401k, you're going to continue for the next 15 years to save to that. At some portion, you already have almost $500,000. You'll probably, given that you got 14 years, even if you ratchet it down to, the 5 or 6% range, you're probably going to be sitting at $1 million or more, probably $2 million.
double. You could just get the double on the money that's already there.
Exactly, more than a double on what's already there.
Yeah,
so you could probably be around $2 million. So that $2 million can get you. You can use some of that, particularly if you want to take it early. You can take it in substantially equal payments to help your income, so that you can get your income back up to where it is now with your pension, and then delay your Social Security, which you then kick that back in, and you're sitting pretty, I think, for the rest of your life.
Yeah, the only question sometimes on some of these municipal plans is you may have Social Security offset of some kind, so that's because you mentioned it depends. It depends on the plan. But not
typically on a pension. It's usually on a like a railroad retirement.
I've seen it though with the city of Bellevue. I've seen it with municipal plans. So at any rate, I mean, the short answer is, get out and enjoy your life. You don't have to save so much money, as Don said. Maybe half of what you're saving today. I mean, that's a lot to put away.
That's considering you're contributing 15% to the pension, which is another reason I think your pension is likely to be fine. That is a pretty sizable contribution to a defined benefit plan this early in it for you, with still 15 years to go.
Still the only one that I know, and you can call me and correct me, but I think only Illinois is the only state I know where they actually reduced the pension a little bit after people started taking it. To me, it's immoral, personally, but that's the only one I know where that has happened. But it's
not happened very often. No. You should be. Here's the problem with the future. We don't know a darn thing about it. We're all guessing. 855-935-TALK. Give us a call.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Should I have the Russian planes removed by an English-speaking country's planes?
Would you please take care of that? We were talking during the break about cars before we go to the phones. And Tom said, so what's a Tesla Model X? So I looked it up. And this is the most misleading website, Elon. It is misleading. When you go, because Tom was wondering what the X is. It's ridiculously expensive. And I went to the page and I look over and I go, okay, the basic Model X is $110,000 roughly, which is, whoa. But wait a minute. That's the price that comes up and you think that's the price? But there's an asterisk next to the number.
Oh, okay.
That's the price after factoring in potential savings on gasoline. That's not a price. There's a button next to it that says purchase price. Oh, guess what? The purchase price is $115,000.
Yeah, you know that I put $1,000 down on the R1S at Rivian, and I think
that's hysterical.
I don't think I'm going to be able to make myself pay $70,000. By the way, it would have been, I think it was 84. They told, they did, anyway, I don't want to get too far into this, but they sent the email, said, we're going to have to charge this much more. And then they got a lot of flack, and they said, we'll give you original price.
And I'm looking to trade in my Armada on a Honda CR-V.
Yeah.
And that's how cheap I am. I'm going to trade it in. Get this. I have two offers. I have an offer to trade it on a gas CR-V or a hybrid CR-V. I found a hybrid, which are hard to find. And in either case, they're going to give me either $2,500 or $5,000 back. I'm going to buy a new car and they're going to hand me money back because my used car is worth so much.
They got any houses for sale? I might buy a house from them.
This is really weird. I'm just going to live in the car.
And this is part of the problem I have with paying a lot for a car. As you know, I don't like to drive anyway. I would drive less and less and less if I could.
I love to drive.
You get up every morning, want to go 200 miles.
And I can't commute because I live and work in the same house. 855-935-TALK is our phone number, and Bill is up next. Bill, welcome to Talking Real Money.
Thank you, Don, for taking my call. My wife and I are 70, and we're both retired. We're going to be downsizing our house, and we want to put about $250,000 into some kind of a fund for potential long-term care someday. I mean, we're both in good health, but you never know. So it's not money that we'd ever need to draw out in one lump sum. If we did ever need it, we'd need it like on a monthly basis, or eventually just go to our kids when we're gone. I know you talked a lot about Vanguard funds, but I went online to look at them, and they're very confusing. So I'm wondering which one you would recommend.
Yeah, I think it's a great question, Bill. I mean, number one, here's the thing. When you say you're never going to use the money, but on the other hand, if you needed it for long-term care, that makes me nervous. Like it should have some bond component to it.
It must have a bond component, Don.
Yeah, and if you're truly going to be one fund.
Target date.
Is that what I'm getting?
Yep.
I was going to say target date or balanced index fund, either one. That has a lot of, target date at 70. Let's see. So that's.
What could be, so what I'd probably do is
like
a 20,
50-50.
A 2030. 2025, 2030 target date, because he's in good health, right? Yeah, he's in good health right now. But as you get older, that's going to become more conservative when your likelihood of going into long-term care increases.
Yeah, so you would just simply type in Vanguard 2030 target date fund. Mm-hmm. That's going to be one fund. You're going to get, pretty good mix there and at a very low cost. I think that's a reasonable approach.
Because it gives you massive diversification without you having to do any work, which is one of the joys of target date funds. I'm going to look it up what its allocation is here. Vanguard Target.
Does that make sense, Bill?
Yes, it does.
All right. And I'm going to look it up here. Hold on. I'll tell you what the allocation is. Target Retirement 20.
I'm going to go out on a limb. The 2030 is going to be a 60-40.
All right.
And it's
the expense ratio is 8 basis points.
8. And it's probably lost 3.5% this year. I mean, so it's been a tough year. Kidding. I think that's a very reasonable approach. Again,
you are darn close. I actually might go with the target 2025, because the target 2030 is about 65-35.
Which might be more aggressive.
It may be a little more aggressive. So the target 2025 is going to be closer to that 55-45 range, which is where I'd go.
And the thing I like what Don said, Bill, is that asset allocation will reduce risk over time. Mm-hmm. So if you get to 80 and you do need the money for long-term care, you'll have more in bonds probably than in stocks, more stability, be able to pull that out and pay the expenses. I think that makes a lot of sense.
On a monthly basis, and it gets more conservative as time goes on, as you continue to make payments. So I just think it's the near perfect solution. There is no perfect solution where you get everything you want with no risk, because you want to take some risk so you get some returns. If you don't take risk, you don't get returns, you make nothing on your money. And the expectation would be that you're going to make 6-7%, hopefully at the beginning. Best case. Yeah, later on you're going to make less. So I think that's reasonable. I hope that helps, Bill. Good luck.
Yeah, so just type in Vanguard.
Here, I'll get you. Actually, here, I'll get you the symbol for it.
Give you the ticker.
Vanguard Target. It's called Target Retirement.
The first is V. V is in Victor.
Oh, yeah. Well, of course you know. Oh, he was acting like he knew the symbol.
Smart, huh? Yeah,
it'll start with V.
Really? It's shocker there.
V. Okay, you do your little phonetic alphabet. VTTVX.
Tango, Tango, V, Victor, Tango, Tango, A as in Alpha, X as in X-ray. You just type that in.
And it's 50. It's 55-45.
55% in stocks, 45% in bonds. Again, very moderate is how I'd put that.
Perfect. That's just what I needed. Thanks very much.
Good luck, sir. Thanks for the call.
Thank you. Yeah.
We do have lines open. You can call us anytime at 855-935-8255, 855-935. TALK. Yes, sir. Are
you going to have the new car by next weekend when I'm down there? Will you take it out for a big spin?
Here's the deal. Uh-oh. This has been the game I've been playing all week. We decided on a CRV. Debbie likes the CRV. Her brother has a CRV. He said, get a CRV. So I do whatever I'm told. Yes. We're trying to decide between the hybrid and the gas. Okay. Now, I was thinking all along the hybrid. Hybrid's the way to go. But turns out, difference between the two is an average of 5 miles per gallon. That's it.
It's weird.
That's it. Although the hybrid is 4-wheel drive. The hybrid is 4-wheel drive and the other is 2-wheel drive, but it doesn't snow in Florida. So
no, not a whole lot. No,
But here's the deal. No one has the cars on the lot. You are now literally, I am placing orders blindly.
Just hoping.
Like, for example, the one I want that's gas will be in on supposedly, but they give it wiggle room. They said it's due on the 29th, but it could be a week later.
Okay. Well, I mean, I've got $1,000 on a car that I'm hoping to see by the summer of 2023.
The hybrid was supposed to arrive yesterday. It is on the truck and scheduled to arrive any moment. So if we go hybrid, then you'll see the new car.
Okay. Is this going to be your car or Debbie's car? Whose car is this?
We don't have our own cars. We drive whatever the other one isn't driving.
Wow. It's so flexible. Well, I'm trying to remember the last time I was even in my wife's car. It's been a long time.
Yeah, we don't have our own cars. That seems kind of, I don't know. So we haven't decided yet whether we're going to take the $4,700 cash back or the $2,300 cash back, which we would get on the hybrid.
Call Don and help him make a
I don't know what to do. 85, and there's an additional dealer markup on them.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Wait, you. Yes, sir, you in the back row. Did you have a question?
I got several. When are you going to retire?
Why? You trying to get rid of me?
What are you going to do when you retire?
I don't know. I'll find something. Maybe I won't
live.
I don't know.
Where are you going to live when you retire?
We're struggling. I don't know.
How are you going to live when you retire?
You're stressing me out with these questions.
You need to know all of these things, and guess what? We answer all of them on Saturday, May 14th in Bellevue at Retire Meet 2022.
You're going to tell me where to retire? Thank goodness. Yeah, this has been an agony figuring this out.
I'm going to hang my hand out in the back of the room. Go to retiremeet.com. Hear from myself, Don, Paul Merriman, Herb Weisbaum, et al. In person. It's going to be a great day, and we're looking forward to seeing you.
RetireMeat.com, because most of the sandwiches have meat in them. RetireMeat.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.